Hello, my name is Narration and this is my brochure on types of loan rates. To start off with, we have a fixed rate loan. And the pros that come with such a loan are that 1, they provide stability. Because the interest rate remains at such a fixed amount, you never have to worry about the interest rate ever going up. 2, predictability, and this source of correlates with the first one, as because your interest rate doesn't change, you can easily finance and budget your money for other stuff. 3, they provide protection against rising rates. The second type of loan rate is the adjustable rate loans, also called ARMs. And the pros that come with such a loan are that 1, they provide stability, but not really in the sense of the fixed rate loans. As with an ARM, the bank usually offers you an initial interest rate that is relatively low to compensate for them being able to change the interest rate after the fixed period ends. Second off, they can provide for potential rate decreases. In the market, if the interest rate ever decreases, then the loan will follow along and also have lower interest rates, which can save money. Third of all, they have a shorter term commitment. These ARMs usually come with shorter initial fixed rate periods, which can serve as flexibility for those who plan to live in the home for a short period or plan to leave soon. And as for the cons, they're very volatile. These ARMs are subjected to interest rate adjustments, which can make monthly payments suddenly jump, making it hard for those who don't have the money to pay off. Secondly, they can provide for a potential payment shock. After the fixed rate period ends, the interest rate can adjust periodically, causing significant payment increases, which can catch those who were comfortable with the initial fixed rate to have sudden shock. Third of all, they provide a refinancing risk. If a person is ever comfortable with their fixed rate, it can be hard to refinance into that fixed rate loan with affordable terms, which can also increase the debt and make it hard for the loan to be paid off in the first place. Now it's time to compare and contrast the two loans. For comparisons, both loans are used to purchase and finance a house. Both loans are also subjected to lender approval, which can include them checking your credit checks and them verifying your income. Third of all, both loans require people to make regular monthly payments, including interest. As for the contrast, they differ in their rate structure, as FRMs have a fixed interest rate for the entire loan term, while ARMs, while having a fixed interest rate for a few years, they will eventually transition to one where the interest rate can fluctuate. And as for the initial rates, on the one hand, while FRMs have a usually higher initial interest rate, ARMs usually have a lower one. Rate adjustments. While FRMs cannot change, which means they cannot increase or decrease within their interest rate, ARMs, after the fixed rate period ends, have the ability to increase or decrease the interest rate based on the market. Finally, the payment stability. FRMs usually offer stable monthly payments throughout the loan, while ARMs, as the interest rate can decrease or increase, they're very volatile. Effects of the economy on FRMs. In a stable economy, FRMs are usually favored, as borrowers can lock in lower interest rates before sudden increases in the interest rates. In the economic uncertainty, FRMs can provide stability as they have a fixed interest rate, which means borrowers won't have to worry about any recessions affecting their fixed rate. And as for missed savings, during periods of deflation or stagnant growth, FRMs can possibly be missing out on money, as the interest rates could possibly decrease throughout the market. However, since the rate is fixed, they do not benefit from this. The effects of the economy on ARMs. In a booming economy, ARMs are not as favorable because banks usually raise the interest rates to control inflation, which will result in increased monthly payments. In a sluggish economy, ARMs could benefit from this, as it may result in decreased monthly payments due to central banks lowering the interest rates. Finally, during economic recessions, people with ARMs should be very, very cautious, as payments can suddenly increase a dramatic amount, and those who can't manage that are in big trouble. Finally, we'll talk about the situations, more specifically when to use an FRM versus an ARM. The first situation deals with maximizing long-term stability. Here's the situation. A borrower plans to stay in their home for a long period and wants predictability and stability in their monthly mortgage payments. And now here's the recommendation. In this case, an FRM would be the better option, as in an FRM, it offers a fixed interest rate regardless of how the market fluctuates or changes. Because of this, monthly payments remain constant and similar, which allows for easy long-term financial planning. The second situation deals with maximizing short-term profitability. In this situation, a borrower can comfortably manage potential payment increases and wants to maximize affordability in their early years of home ownership. And now here's the recommendation. In this scenario, an ARM would be better than FRM, as a bank usually offers a lower initial interest rate in an ARM than when compared to an FRM. This lower initial interest rate can allow for lower monthly payments, which for those who are in the early years of home ownership would benefit more from.